What's up, everybody? In this video, I'm talking about my plan to buy Adobe and Tesla stock in 2023. I'm going to walk through the current stock price, the fundamentals, what their growth looks like, and then run a discounted cash flow analysis to come up with some price targets and show you the range that I plan to buy Adobe and Tesla stock in 2023. And I'm going to tell you my approach to buying shares. Is it to go all in at once or to spread it out over time? Let's talk about all of it in this video. All right, first up, let's look at Adobe. It's down 40% year to date, right? But let's zoom out a little bit and let's look. Since 2000, the stock is up almost 2,000%. All right, let's run through some facts about the company. It's a $156 billion market cap, trading at a price to earnings ratio of 32. But if we look at their growth expectations, the forward price to earnings ratio is 22. Okay, Adobe has revenue increasing at about 14% per year. Gross profit expected to increase about 13%. Operating income is increasing. Net income is decreasing, but this is just because of some money that they're spending on an acquisition. And then the profitability of this company is extremely strong. Gross margins at almost 88%, operating margin at 35%, net margin at 28%, free cash flow margin at 43%. So very strong there. And then they get a strong return on invested capital at 35% and 34% return on equity. If we look at its PE, it's at 32.5, which is below its 5-year average of 49. Okay, but we're going to talk about what that looks like moving forward. Price free cash flow is at 21, which is again below its 5-year average of 37. And so we like to see that. The forward price to earnings growth ratio is 0.69, which is exactly what we want to see. We want to see this 1 or below, because that shows that the price to earnings ratio is lower than its expected earnings growth rate. And it is outperformed the S&P 500 over the last 5 years, which is great. In terms of what analysts expect, I'm going to give you my own price estimations or price targets, but there's a high price target from analysts of 498. The average is 378 and the low is 313. And then from a growth perspective, through 2026, analysts are expecting revenue to grow at a low of about 6.28% per year and a high of 7.78%. And if we look at earnings per share growth, expected to be on average, again, compound annual growth rate of through 2026, 17% revenue growth on the low side to 18.5 on the high side. And we're going to use this in our discounted cash flow analysis when we think about our price targets. Okay, I think a great way to look at this business, especially going in 2023 in recessionary times when, times are going to get tougher on the economy, we want companies with strong free cash flow, which is one of the things I really like about Adobe. So I think looking at it on a price to free cash flow basis is a great way to evaluate the stock. So what we have here is a chart of the free cash flow, the price free cash flow since 2004. And down here, if we scroll down, we can see it's traded at a low of 7.5. The average has been 26.51, a high, which is ridiculous, at 55, and then currently it's at 21.15. So if we look at its average over this time of 26 and its latest of 21, I like to see that below its average, right? But what we really need to come up with is our own estimate and idea of what we think we would want to pay for a stock, and that's how we're going to come up with our plan to buy shares and where we would buy them at. So we're looking at it on a price to free cash flow or free cash flow basis. We're going 5 years out. And the way we're going to get this annual free cash flow growth, it's been 20% over the last 5 years, but I want to know what it's expected to be over the next 5 years. And so if we jump over to Ticker, which has analyst expectations out to 2027, it's expected a compound annual growth rate of 11.4%. So we'll use just a round number. We'll go a little conservative. We'll go 10%. We see that they've dropped shares by 1.25% per year. I think they might be more aggressive than that. So we'll do minus 2%. And then we can see the average price to free cash flow over the last 5 years has been 36. But I want to reduce that a lot. I think the stock has been overvalued or traded at too high of a price to free cash flow. So we're going to bring that down by 12 to a price to free cash flow of 24, which again brings that down by 12. It brings it down by about 30%, right? Discount rate, what is the expected return we want? 10%. And so what this will do is it'll give us what the projected price would be based on everything we just put in out to 2027. So we have the fair value price at $6.94 based on these numbers we just put in. And so that means that the current stock price is $3.38. The fair value is 425. That's what we would pay right now. So it's a 25%, upside from here, or we could look at that as a margin of safety, right? And then the future stock price, again, out to 2027 would be 694. That's 105% gain for 15% compound annual growth rate, which is a fantastic return if you can get that. Almost any investor should be happy with that. And then down here we see, is this a realistic number? So what free cash flow out to 2027 will be 11.9 billion. I think that's realistic, growing from 7 billion today, 7.4 billion today, to 11.9 billion. It's not even a double by 2027. Now, some ways we could adjust this number, right? Maybe we think it will trade at a lower price to free cash flow. So that means it's trading closer to fair value right now. Fair value would be 354, and the current stock price is at 338, and then we'd only be looking at 11.32% compound annual growth rate if it was trading down to a price free cash flow ratio of 20. But what if we get a price free cash flow ratio of 20 and they only keep bringing shares down by 1.25% per year? Well, then it's trading almost right at fair value today of 334, and we'd be looking at a 10% annualized return. So my plan, in 2023, Adobe is going on my watch list, on my buy list to consider buying and adding shares, and I would just do it over time, right? I would set it to where I bought every other month or every a little bit every month as I made my contributions on that. I would not just invest everything at once in the stock. That's just me. If the stock gets to 330, around 330, I would be really interested in it. Anything below 330 is like super interesting to me. But if it gets above 360, 370, then I would definitely hold off on buying any more, and then maybe wait it to get back down to 310 to 330 level or something like that. So that's how I'm thinking about Adobe. It's a fantastic company with a proven track record. They have subscription products, very high gross margins, a strong cash position. This stock I feel very good about owning for the long term. All right, Tesla. Tesla is much more volatile generally than Adobe, and much more in the news headlines than Adobe, just because of some of Elon Musk's antics. If we look long term, the stock is up more than 9,000% since 2013, so absolutely destroying the S&P 500. We're going to go through the same things about Tesla, and I'm going to tell you what I think the fair value is and my plan to buy and accumulate more shares. I already own Tesla, so this would be where I plan to add shares. Okay, and with all the negative headlines and everything about Elon Musk and all the fear and everything, this is one of the lowest PE ratios that Tesla has traded at in recent history, and it's gotten much more reasonable than the stock price was previously if you look at it on a forward PE basis. And so again, strong revenue growth expected, gross profit is expected to increase, operating income is expected to increase, net income, and then operating cash flow is also expected to increase. Okay, margins are going to be a lot lower for Tesla because right now they make most of their revenue from automobiles, and it's a much lower margin business. For an automaker, they do have high margins. They also have good return on invested capital and return on equity. So we like to see that from Tesla. If we can remove ourselves from all the drama, all the Elon Musk headlines, Tesla has had very strong growth. That can't be argued. And it's trading at a much more reasonable valuation than it has in recent history. We jump over to analyst price targets. The high right now is 457. I think that's completely unrealistic by 2023, by December 2023. The average is 269. I think that's more realistic, but I still don't expect to get there by 2023. And then the low is 24. I also actually think that is unrealistic too, right? If we want to look at those growth expectations, the compound annual growth rate for revenue growth, low to high is 22% on the low side and then 24% on the high side. Again, that is compound annual growth rate each year, right? Compounded. Earnings per share, 28.7% on the low side and then 30% on the high side, right? So very strong growth expected from Tesla, even with kind of everything that's going on in the economy. And so Tesla, doesn't have a stable enough history of price free cash flow to measure it, just because it was in hyper growth stage, it was unprofitable, had negative cash flow for a long time. But I think something like Ferrari is a good comparison for Tesla. And if we see the low price free cash flow ratio, and this is since 2012, it's been 16, the average has been 88, the high is 541, and the latest is 83, right? That's still, really high. Even if we want to look on a PE basis, The low for Ferrari has been 22 over this time period. Average has been about 40. High 70, and the latest is 53.9. If we look at Tesla, its PE is actually much, much lower than Ferrari's, right? So why am I comparing it to Ferrari? Well, if we want to take a look, Ferrari's revenue growth in 2021 was 23%. Its net income growth, or its net income margin, was 20%. Its EPS growth was 56%. Free cash flow growth was 217%, but 13% free cash flow margin. Gross margin was 51%, so that is stronger than Tesla's, obviously. If we jump over to Tesla, revenue growth is much stronger, 54%, but that net income margin is about the same, 17 to I think about 19 for Ferrari. And then the free cash flow margin is also very similar between Tesla and Ferrari, right? So decent things to compare to. But moving forward, Ferrari is expected to grow through 2026, revenue at about a 10% compound annual growth rate, earnings per share at about 13%, and then free cash flow at about 20%. Whereas if we look at Tesla, they're expected to grow revenue at about 30% per year through 2026, net income at about 27%, earnings per share at 25%, and then free cash flow at 44%. So actually much stronger growth expected to come from Tesla than from Ferrari. So Tesla may not be that overvalued like some people are saying right now. So let's do a DCF analysis on Tesla and think about where we might buy the stock. So again, free cash flow projecting 5 years out, using that 30% growth rate. Again, actually being more conservative than what's expected here. 44% is what's expected. We're doing shares outstanding growth rate of 2%, which is a lot down from its 5-year average, but we'll do a range on this and get an idea. The price free cash flow ratio of 30, and then we're doing that same discount rate of 10%. That's our desired return rate. And what that does is that says the fair value is 176. That's what we would pay right now. Future stock price of 284, which is 130% gain by 2027 for a compound annual growth rate of 18%. Now, what if they grow shares by 5% per year? Well, that brings the fair value down to 152 today, still undervalued today, so we'd still be buying today. The future stock price of 246 and compound annual growth rate of 14.85%. But what if they only grow shares outstanding by 5% and then they only get a price free cash flow ratio of 20, not of 30? Well, then fair value is 101, so a 17% drop. And the future stock price out to 2027, this is December 2027, will be 164, which is only a 6% compound annual growth rate. But if we go back down to that 2% shares outstanding growth, even at a 20 free cash flow ratio, price free cash flow ratio, then we're almost right at fair value today. Fair value would be 117. Future stock price would be 189 for a compound annual growth rate of 9%. Right? So my approach to Tesla, where I would accumulate more shares. There's really anything around or below 120. I don't care about a few dollars here or there. If shares get up to 150, 160, I'm not going to sell my position, but I definitely wouldn't be adding more shares. If they get there over the next year or something, I just think that would be a time to just hold off on adding. But again, I'm a long-term investor, so I'm not looking to, be selling out of my position if the stock appreciates by 10 or 20% or something like that. I just wouldn't look at that as an opportunity to continue adding more shares. Thanks so much for watching. If you found this video helpful, you can support me by liking the video and subscribing to the channel. If you like the video, it helps more people find it. If you subscribe to the channel, you'll never miss an update. I do portfolio reviews and share my analysis of all kinds of different stocks. Drop the name of a stock in the comment below and I'll do an analysis when I do a subscriber review episode.